The textbooks tell a very basic story about World War I: assassination, alliances, armies marching to their doom. But the records reveal something the history books skip over entirely. In July 1914, Europe's banking system was dying from its own weight, not from any war. London was the world's financial center, and by late July, its markets had frozen solid. Shares crashed overnight, while depositors couldn't access their funds for days at a time. The London Stock Exchange shut down completely and stayed closed for 5 months. This wasn't just Britain facing trouble. Some 50 countries around the world faced simultaneous financial crisis. Bank runs spread like wildfire. Stock markets collapsed across continents, and a global system built over decades was melting down. The disaster didn't originate in August with the outbreak of gunfire. It had been choking the life out of banks throughout 1913, long before any archduke was assassinated. Behind the marble facades and polished brass fixtures, bankers were scrambling to hide what their balance sheets revealed. Credit markets in London, Paris, and Berlin had been seizing up for months. Reserve ratios had fallen to dangerous lows across the entire system. Many major institutions were operating on the thinnest margins imaginable, one bad day from total collapse. Gold, the foundation holding the entire system together, was being hoarded by central banks in a desperate scramble. This created a liquidity drought that threatened to bring down even the strongest institutions. Banks couldn't simply print money to save themselves from the approaching disaster. The gold standard had become a straitjacket, and one major depositor panic would trigger a chain collapse nobody could stop. Then something remarkable happened when war was declared in August. Suddenly, the banking system that should have died was rescued. Normal rules were suspended overnight without debate. Gold requirements disappeared as if they'd never existed. Government guarantees flowed to the banks in unprecedented amounts. The crisis that had been building for years was instantly blamed on the war emergency rather than decades of reckless expansion. What if the greatest conflict in human history wasn't a disruption to finance, but its salvation? To understand why the war became a rescue operation, we need to see how banks had built their own trap over 4 decades of reckless expansion. Between 1870 and 1913, European banks grew their deposit bases by roughly 400%, while gold reserves increased by barely 80%. This imbalance in mathematics created an inevitable disaster that bankers clearly saw but refused to acknowledge in public. Fractional reserve banking had always involved risk, but by 1913, the system had been pushed to its absolute breaking point. Each bank's survival now depended entirely on every other bank remaining solvent, creating an interconnected house of cards, where one collapse would trigger a cascade. The bankers had created a system where individual caution meant nothing. Collective failure was the only possible outcome once confidence broke. The colonial lending spree had turned into a nightmare that kept bank executives awake at night. Massive loans to South American governments were bleeding red ink, with Argentina's default in 1890 serving as just the most visible wound. The Ottoman Empire's debt crisis was spreading financial contagion across every institution that had believed in endless imperial expansion. African colonial ventures that were supposed to generate profits were instead producing nothing but compounding losses on the balance sheets. Domestically, the vulnerabilities were just as severe and far more immediate. Property speculation bubbles in London and Paris had inflated real estate values beyond any rational calculation. Industrial loans to steel manufacturers, railway companies, and overbuilt factories represented exposure to sectors with massive overcapacity. Consumer credit had expanded without adequate collateral backing, and the first wave of defaults would reveal just how hollow these loans actually were. But the gold standard created the ultimate stranglehold that made every other problem unsolvable. Banks couldn't just print their way out of trouble because gold convertibility prevented any monetary expansion. This meant depositor runs became existential threats. Any loss of confidence would trigger bank death within days. Central banks competed with each other for the finite gold supply, driving hoarding behavior that drained liquidity from the entire system. The banks had chained themselves to a system that guaranteed their destruction the moment the public stopped believing in their solvency. By 1913, the panic was no longer theoretical. It was happening behind closed boardroom doors across the financial capitals of the world. The Bank of England held emergency consultations with Treasury officials throughout the year as liquidity pressures mounted. The Rothschild family, with branches spanning London, Paris, and Vienna, coordinated their responses to the deteriorating conditions they could see spreading across the continent. JP Morgan's partners were sending private warnings to the architects of the newly proposed Federal Reserve System in America. The Warburg brothers maintained constant communication between their European banking operations and their American interests, watching the crisis build from both sides of the Atlantic. The warning signs were visible to anyone with access to the real numbers, and insiders were paying very close attention. interbank lending rates began spiking in the first half of 1914. As institutions grew increasingly reluctant to lend to each other, major banks were quietly liquidating questionable assets before the markets could realize just how worthless many of these holdings had become. Insurance companies started refusing to underwrite certain bank bonds, a clear signal that actuaries were seeing risks the public statements weren't acknowledging. Wealthy clients who maintained close relationships with senior bankers received private advice to diversify their holdings out of bank deposits. The mechanism of concealment required coordination across multiple institutions and even into the media itself. Banks owned or heavily influenced major newspapers and financial journals, and bad news was systematically suppressed to prevent the panic everyone feared. Government officials coordinated their public messaging carefully to maintain confidence while privately preparing for the worst. Creative accounting practices masked reserve deficiencies that would have triggered immediate runs if depositors had known the truth. Banks even entered into informal agreements to support each other's stock prices, creating the illusion of stability where none actually existed. What the bankers knew, and what terrified them, was that a single major depositor panic or sovereign default would trigger a chain collapse that no amount of coordination could stop. They required either a major diversion or a total reset of the system. They got both when the war began in August 1914. The outbreak of war in August 1914 provided exactly the mechanisms banks needed to survive what should have been their extinction event. Within days, normal rules that had governed banking for generations were suspended across Europe and America. The gold standard that had constrained every banking decision was abandoned almost overnight, meaning banks no longer had to redeem their paper promises for actual gold. Stock exchanges closed for months. New York stayed shut until December, London for 5 months, preventing the panic selling of bank shares that would have exposed their true worthlessness. Debt moratoria were declared across the continent, which meant all those failing loans that had been hemorrhaging losses were suddenly frozen rather than coming due. Government guarantees extended to the banking sector completed the rescue operation. The British government agreed to provide taxpayer guarantees against any losses incurred by the Bank of England as it bought up financial assets that had plunged in value. The Currency and Banknotes Act of 1914 was implemented on August 5th, just one day after Britain declared war on Germany. New currency was printed in massive quantities, with the monetary base expanding from 288 million in 1914 to 531 million by 1918. The war provided the perfect excuse for every pre-existing problem on bank balance sheets. Failed colonial loans could now be reframed as patriotic investments in empire defense rather than reckless speculation. Illiquidity that had threatened bank collapse was suddenly redefined as supporting national mobilization efforts. All the mismanagement and reckless lending of the previous 4 decades was instantly blamed on the war emergency instead of the bankers who had created the crisis. But the real transformation came when governments became captive customers of the banking system. Nations needed immediate massive loans for mobilization, and banks suddenly became the sole source of war financing. This reversed the traditional power relationship. Governments couldn't let banks fail because losing their lenders meant losing the war. Banks gained unprecedented leverage over sovereign debt for the first time in modern history. British banks lent extraordinary sums to the government in the first year alone, with loans backed by future taxation rather than gold reserves. German banks absorbed government war bonds at preferential rates that guaranteed profits regardless of the war's outcome. French banks restructured their entire portfolios under government emergency powers, converting private losses into public obligations. American banks, though officially neutral until 1917, financed all sides of the conflict and eliminated any distinction between good and bad loans in the process. While generals planned troop movements, bankers orchestrated something far more permanent: the largest balance sheet laundering operation in modern history. Banks held billions in questionable private debt that had been deteriorating for years: failed railroad ventures, speculative real estate loans, and colonial projects that would never produce returns. Governments needed liquidity immediately for mobilization and couldn't wait for traditional tax collection processes to generate funds. Banks offered a solution that served their interests perfectly. They would exchange their risky private loans for newly issued government war bonds. The transformation was elegant in its simplicity and devastating in its consequences. Risk that had been concentrated on bank balance sheets, where shareholders would bear the losses, was transferred to government ledgers, where taxpayers would carry the burden for generations. Deutsche Bank's failing Ottoman railway loans, which had been effectively defaulted on before the war, were swapped for German war bonds backed by future reparations, expectations that never materialized. British banks converted their massive South American exposure, bleeding losses for years, into what was repackaged as empire defense financing. French banks held enormous quantities of Russian loans that would become worthless after the revolution. But during the war, these were transformed into Allied mutual support obligations. The scale of this operation was staggering when measured against the size of national economies at the time. The British government alone provided some £200 million to banks through various revival schemes, representing roughly 9% of the entire national GDP. This was state intervention in the financial system on what contemporaries describe as a hitherto unimaginable scale. Banks emerged from 1914 and 1915 with cleaner balance sheets than they had maintained in 2 decades, with new accounting standards introduced under war emergency rules, allowing creative categorization of assets. The cost was borne by those who had no voice in the transaction. Future taxpayers were committed to debts they never agreed to assume and had no role in creating. Inflation transferred wealth systematically from savers to banking institutions as currency expanded to accommodate war financing. Currency devaluation enriched debtors, the banks holding government bonds at the direct expense of creditors who had trusted the system with their deposits. But one institution saw the war coming and positioned accordingly. The Federal Reserve Act was passed on December 23, 1913, during the holiday recess when congressional opposition was at its minimum. By August 1914, exactly when war mobilization required massive lending capacity, the Federal Reserve was operational and ready to serve. The key architects of this new central banking system, Paul Warburg, partners from the House of Morgan, and members of Loeb, all maintained deep ties to the European banking operations that were experiencing the crisis firsthand. What the Federal Reserve enabled transformed American banking in ways that seemed almost designed for the crisis ahead. The elastic currency provision meant banks could now expand the money supply without gold backing, eliminating the constraint that had threatened European institutions. The lender of last resort function gave banks somewhere to turn instead of facing liquidity death when depositors demanded their funds. The discount window allowed troubled assets to be temporarily stored at the Fed rather than forcing banks to recognize losses immediately. The Fed's war financing role began almost immediately despite official American neutrality. Federal Reserve officials coordinated American bank loans to Britain and France, providing the liquidity that allowed those governments to continue fighting. The Fed managed gold flows carefully to prevent domestic banking strain while enabling massive lending overseas. By the time America entered the war in 1917, Fed member banks held roughly $2.5 billion in Allied obligations, amounts so large that letting the Allies lose would have meant catastrophic bank failures across America. The convenience of this timing was remarkable. The Fed's creators had claimed it would prevent panics like the one in 1907. The war immediately proved its value by enabling unlimited bank bailout capacity. What was sold as a temporary emergency measure never ended. It became the permanent architecture of American finance. When the armistice was signed in November 1918, the banking system that emerged looked nothing like the one that had been collapsing in 1914. Institutions that should have failed during the pre-war crisis now dominated their governments rather than serving them. Banks that survived didn't just recover. They emerged as monopolies after smaller competitors failed or were absorbed during the war years. Government debt dependence had fundamentally reversed the traditional power relationship, making sovereigns subordinate to their creditors for the first time in the modern era. The transformation of power was complete and permanent. Before the war, governments had regulated banks and dictated the terms of financial operations. After the war, banks dictated terms to governments, demanding austerity measures, controlling reparation structures, and determining reconstruction loan conditions. The Bank of England forced Britain to return to the gold standard in 1925, specifically to protect bank creditor interests. Even though the policy devastated employment and industrial production, what had been sold as temporary emergency powers became the normalized structure of modern finance. The suspension of the gold standard was never fully restored to pre-war conditions. Government debt levels remained at wartime multiples throughout the 1920s and beyond. Central bank independence, which really meant banker control of monetary policy without government oversight, became the accepted doctrine. The too-big-to-fail concept was firmly established, making major banks effectively untouchable regardless of their behavior. The winners of this transformation could be measured in concrete numbers. J.P. Morgan and Company saw its assets grow from roughly $550 million in 1913 to $1.2 billion by 1919. Britain's banking sector consolidated dramatically from 38 major institutions in 1913 to just 5 dominant banks by 1920, the big 5 that would control British finance for generations. Federal Reserve member banks in America tripled their deposit base during the war years. The losers bore costs that would compound for decades. Citizens holding pre-war currency savings watched inflation destroy 50 to 90% of their purchasing power across Europe. Many local banks went under or were taken over by the major players. Entire nations found themselves perpetually indebted to a banking system that had been on the verge of collapse just years earlier. The pattern established in 1914 didn't disappear after the war ended. It became the template for every major financial crisis that followed. The crisis response consolidation cycle repeats with remarkable consistency across different eras. In 1914, war emergency led to gold suspension, bank bailouts, and permanent system expansion. In 2008, the financial crisis triggered TARP bailouts, quantitative easing programs, and even bigger banks emerging stronger than before. In 2020, the pandemic response brought unlimited Federal Reserve lending, trillions in bank support, and asset price inflation that transferred wealth upward. The mechanisms employed are functionally identical across all three events. Normal rules get suspended during the declared emergency. Whether it's gold convertibility in 1914 or traditional Fed lending limits in 2020, private losses are transferred to public balance sheets through bailouts disguised as systemic stability measures. Central bank powers expand permanently under temporary emergency authorities that somehow never expire. Industry consolidation occurs through selective rescue operations where big banks get saved while smaller competitors are absorbed or fail. This specific modern parallels reveal how little has actually changed in over a century. In 2008, the Federal Reserve took $4.5 trillion in toxic assets onto its balance sheet, functioning exactly like the World War I war bond swaps. During 2020, the Federal Reserve directly purchased corporate bonds for the first time, breaking traditional limits that had theoretically constrained central bank intervention. Current bank failures like Silicon Valley Bank and First Republic resulted in further consolidation among the largest institutions rather than any meaningful reform. What bankers learned in 1914 shaped financial crisis management for generations. Large-scale crises create permission for actions that would be unthinkable during normal times. The public accepts temporary measures that quietly become permanent fixtures of the system. Bailouts can be disguised as patriotic duty or systemic necessity rather than what they actually are. Transfers from taxpayers to bank shareholders. Most importantly, those who created the crisis consistently end up more powerful after the rescue than they were before the collapse. The global banking system today faces the same structural vulnerabilities that threatened it in 1913, only exponentially larger in scale. Banks are again over-leveraged with derivatives exposure measured in the hundreds of trillions. Central banks have pushed traditional tools to their absolute limits with interest rates and balance sheet operations. The same interconnected fragility exists where one major failure could trigger systemic collapse. Warning signs are visible to those watching closely, just as they were over a century ago. Bank executives quietly sell personal stock positions while regulators grant exemptions that don't make headlines. The insiders position themselves before the public understands what's coming. History reveals a pattern that most people miss entirely. Banking crises aren't failures of the system. They're opportunities for consolidation and transformation. Every major conflict or economic crisis coincides with fundamental changes to the financial architecture. The institutions that survived World War I were those positioned to benefit from the reset, not those caught unprepared. Current geopolitical tensions may serve the same function that 1914 tensions did, providing cover for a financial system restructuring that's already necessary. When they talk about financial stability, the question becomes stability for whom? The system is designed to preserve institutions, not the savings of ordinary people. Deposits represent bank liabilities, and every crisis transfers that burden back to depositors through inflation, bailouts, or currency devaluation. Understanding this pattern provides something most people lack: the ability to see what's actually happening rather than accepting official narratives. Real security doesn't come from trusting bank promises, but from recognizing when the cycle is repeating. Those who understand crisis patterns position differently than those who trust institutional assurances. The generation that lived through World War I learned these lessons too late. This generation doesn't have to repeat that mistake. Banks faced extinction before World War I broke out. Today, they face the same structural problems with a system even more precarious than before. The question isn't whether another reset is coming. It's what emergency will be used to justify it this time. War didn't disrupt the banking system in 1914. It saved banks from their own failures. The next crisis will further consolidate banking power unless enough people recognize the pattern being repeated. The signals are already being sent if you know where to look. Bank stock movements, regulatory policy shifts, and Federal Reserve decisions all tell a story beneath the official explanations. Understanding the system as it actually operates is the only real protection available.